Welcome to this Chapter 17 tutorial on Section 87 amalgamations and Section 88.1 winding up of a 90% owned sub into its parent corporation. Now, both of these sections are very similar in terms of the tax implications, so that's why we're reviewing both of them together in this tutorial. Moving on to the next slide, let's start first with a Section 87 amalgamation. Now, the common application is there are two former companies that are going to merge and continue on as a new corporation. So we might have Company A, Company B. They're two separate corporations. They decide for business reasons that they want to merge and form Company AB Limited, a newly amalgamated corporation. And the former companies, Company A and Company B, will basically be dissolved. So the beauty of a Section 87 amalgamation is that it's automatic. There's no election that has to be filed with the CRA. In addition, it allows for the tax-free transfers of assets from the two former companies into the newly amalgamated corporation, so tax-free rollover. And also, the former shareholders, the shareholders that own shares in the former corporation, for example, Company A and Company B, they're just going to exchange their old shares for shares of the newly amalgamated corporation. Now, with a Section 87 amalgamation, boot is not allowed. It's just exchanging the old shares for new shares. No boot is allowed. And also, any loss carryovers from the two former corporations will flow to the newly amalgamated corporation. So any non or net loss carryovers will just flow to the newly amalgamated corporation. Now, the acquisition of control rules will apply, so just sort of keep that in mind as well. And also, there's going to be a deemed year end for the predecessor corporations. And once again, if any loss carryover is transferred to the newly amalgamated corporation, because there's a deemed year end, that's going to use up one of those loss carryover years, for example, in the case of non-capital loss carryovers. Moving on to the next slide, let's take a look at a basic example. So we have Company A and Company B. Those are the old corporation. They want to merge to form AB Limited. So Company A, Company B, those are the former corporations, and they want to merge and amalgamate to form AB Limited. Now, the shareholders, the former Company A and Company B shareholders, they're going to give up their Company A and B shares. Those are the old shares. They're going to give those up, and in return, they're going to get new shares in the newly amalgamated corporation, AB Limited. So this is a basic example of a Section 87 amalgamation. And once again, it's fairly straightforward. There's going to be no immediate tax consequences in this Section 87 amalgamation. Moving on to the next slide, let's talk about some conditions. The predecessor corporation, so in our example, Company A and Company B, they both must be taxable and Canadian corporations. Now, all of the property goes to the new corporation. So all the assets and liabilities of the former companies must flow to the new corporation. And the consideration that the shareholders receive must only be shares. There cannot be any non-share consideration or boot given. The economic outcome is that all the assets and liabilities will be carried over at their former tax values, and the new shares will have an ACB equal to their old shares. So basically, all the tax values remain intact. Moving on to the next slide, what about the newly amalgamated corporation? Well, the asset transfers will be at cost. Inventory will be transferred at cost. So inventory will be held by the newly amalgamated corporation at the cost held by the former corporations. Any depreciable property will be at UCC. The old capital cost will be retained for any recapture and capital gains purposes. And for non-depreciable property, that will be held at ACB as well. Now, any tax accounts, any capital dividend accounts, any RDTOH balances, those will be transferred to the newly amalgamated corporation, subject to the last bullet point, both the predecessor corporations must be private. Now, if one predecessor corporation was public and one was private, then these accounts will not transfer over. The new corporation will be public, and so they won't be able to transfer over the CDA account or the RDTOH balances. Moving on to the next slide now. The position of the newly amalgamated corporation that is formed, that new corporation can select any new fiscal year. And so the fiscal year will start at the time of the amalgamation, and they can select any fiscal year end. So it could have a short first fiscal year. Any GRIP, the general rate income pool, that will carry forward to the new corporation. Now the shareholders, they're going to be deemed to have disposed of their old shares of the former corporation, but they're going to be disposed of at the ACB, so there's going to be no capital gain. And the new shares will just retain the ACB value that the old shares had. So once again, no difference in terms of tax values. We're going to move on now to a Section 88(1) winding up of a 90% subsidiary. Now, Section 88(1) winding up of a 90% subsidiary, the simple diagram is shown here. All that is happening is that we have a parent company that owns at least 90% of a subsidiary, and all it's going to do is going to be wound up into the parent company. So the subsidiary will no longer exist. All the assets will just be transferred to the parent company. The parent company will continue to operate the operations of the subsidiary. It's just that the subsidiary as a legal separate entity will no longer exist. Now, this is also similar to a vertical amalgamation, where it's a 100% owned subsidiary. So we have a Section 87 vertical amalgamation. It's similar to this example. The only difference is that the parent owns 100% of the subsidiary. In a Section 88(1), a minimum of 90% must be owned. So what would happen in a Section 88(1) wind-up is that the subsidiary shares are canceled and all the assets will just transfer to the parent company at tax value. So the outcome of a Section 88(1) is very similar to the outcome of a Section 87 amalgamation. Now, once again, the parent must own 90% or more of the subsidiary. Both of the companies must be taxable Canadian corporations. And there's going to be a disposition of the assets by the subsidiary and an acquisition by the parent. Now, the deemed proceeds of disposition by the sub will equal the cost of the parent. And as we'll see in a second, there's going to be no recognition of any accrued gains or recapture, so there will be no immediate tax implications. The inventory is going to be deemed to have disposed of at cost by the subsidiary, so no gain needs to be recognized. The non-depreciable assets will be deemed to have disposed of at cost as well, and depreciable assets will be deemed to have disposed of at UCC. Now, the capital cost will be retained for any recapture and capital gains purposes. Moving on to the next slide. There also is an asset bump up possible for only non-depreciable assets, for example, land. Now, this asset bump up is available for a Section 87 vertical amalgamation, where the parent amalgamates with the 100% owned subsidiary, and is also available for a Section 88(1) winding up of a 90% owned subsidiary. Now, this is done to reflect any excess that the parent's investment cost is over the sub's tax value. So basically that excess will not be lost. Some of it could be bumped up in terms of non-depreciable asset values. So how do we calculate the asset bump up? Well, it's the lesser of two amounts. So the bump up is the lesser of the first bullet point, the excess of the fair market value of just the non-depreciable assets at acquisition over the tax cost of these non-depreciable assets at acquisition as well. When we talk about acquisition, we're talking about when the parent acquired control of the sub. That's the first amount. And the second amount is the ACB of the shares that the parent owns in the subsidiary, less the tax costs of the subsidiary's net assets at the time of wind up, and also less any dividends paid to the parent from the sub since acquisition. So that would be the determination of the bump up, and that bump up can only be applied to non-depreciable assets. Moving on to the next slide, let's talk about the disposition of the subsidiary shares by the parent. So those shares will be basically canceled, so there's going to be a disposition. Now the deemed proceeds of disposition will equal the ACB of the shares, so there's going to be no capital gain that needs to be recognized by the parent. Now the only exception is when the sub's net assets that are transferred and the PUC of the subsidiary shares are greater than the ACB of the subsidiary shares. In that situation, a capital gain will arise. Now, let's take a look at how we determine the proceeds of disposition then. So the proceeds of disposition can be restated as the greater of two amounts. The first amount is the lesser of the PUC of the subsidiary shares and the sub's net assets that are transferred at the wind up. So that's the lesser of those two amounts. That's the first criteria, but it's the greater of that amount and the ACB of the shares. So once again, both the PUC and the cost of the net assets must be greater than the ACB of the subsidiary shares in order for a capital gain to arise. A capital loss will not be possible. What I want to do next then is look at assignment problem 17-5 in your textbook. Read through that problem, assignment problem 17-5, and summarize the results of part A. Now part A is looking at the amalgamation of Palomar, which is the sub, into Hubble, the parent. Now this will be a vertical amalgamation. It's a 100% owned subsidiary. So just sort of refresh your memory of what happens in amalgamation and see if you can just sort of summarize the results of the amalgamation from the subsidiary Palomar into the parent Hubble. So pause the video now. Once you've done part A, then resume the video. Okay, let's take a look at the part A results on the next slide. Palomar is going to be amalgamated into Hubble, and because Hubble owns 100% of Palomar, this is a vertical amalgamation. Now, the assets of the sub, Palomar, will just flow to the amalgamated company. In this case, it's going to be Hubble at its tax values. So the equipment will flow at the tax value of $3,300, the land as well. Now, because the goodwill has no tax value, it's going to be assigned a zero tax value, and that will definitely flow to Hubble as well, but at a zero tax value. And because all the assets are being flowed at the tax value, there's no immediate tax consequences. Now, Hubble is deemed to have acquired the assets at these tax values. Now, we need to determine then, is there going to be a bump up available for the non-depreciable assets? And the only non-depreciable asset is the land. Now, the formula that we have to use is the lesser of two amounts. The first one is the excess at the fair market value of the non-depreciable asset at the time of acquisition of control. And so the land at the time of acquisition had a fair market value of $209,000 over the tax cost at acquisition. Now we're going to assume that that's the same as the current tax cost of $154,000. So the first amount is going to be $55,000. Now the second amount in the determination of the bump up is the ACB of the shares, which is $231,000 less the tax costs of the subsidiary's net assets at the time of the wind up. That's going to be the total of the equipment tax cost and the land tax cost of $157,300. And then we also have to subtract any dividends that the parent has received since the acquisition, and Hubble has received $5,000 of dividends. And so the second amount in this bump up determination is $68,700. So the lesser of those two amounts is the highlighted amount of $55,000. So that means we can bump up the non-depreciable asset, which is just the land, by $55,000. So the cost of the land that will be held by Hubble will be $209,000. Now the goodwill once again has a nil tax value, so we don't have to assign any value to the goodwill in this amalgamation. So that's sort of a summary of the vertical amalgamation results. And once again, there's no immediate tax consequences to either Palomar or Hubble. Now moving on to the next slide, looking at part B of the question, the same situation, but now Palomar will be rolled into Hubble using a Section 88(1) winding up of a subsidiary that is 90% or greater owned. And so Hubble owns 100% of Palomar, so this could be accomplished using Section 88(1). Now, the same results will happen. There's going to be no immediate tax consequences to Palomar or Hubble. So once again, that's why Section 87 amalgamation and Section 88(1) winding up are very similar. There's going to be no immediate tax consequences. Now, Palomar will be deemed to have disposed of assets to Hubble at its tax cost. So once again, no gain. Hubble will acquire these assets at its tax cost. The bump up will still apply, so the land will have a value to Hubble of $209,000. Now, when looking at Section 87 amalgamations and Section 88(1) winding up of a 90% or more owned subsidiary, your textbook has a figure that compares the two types of reorganization. So take a look at that figure in your textbook. There are some minor differences, but generally speaking, there are no immediate tax consequences under either section. Now, a Section 88(1) wind up allows for the tax-free transfer or rollover of the assets provided 90% is owned of the subsidiary by the parent. Now, in the textbook, there's also a Section 88(2) wind up. That is very different from a Section 88(1). A Section 88(2) is the general wind up corporation rules, and that is where the parent controls but owns less than 90%. So if it's 90% or more, we fall under 88(1), and that allows for a tax-free transfer. If the parent controls but does not own 90% or more, then the windup would fall under 88(2), and that does not allow for a tax-free rollover or transfer of assets. So Chapter 17 talks about 88(2) as well, but just realize that the differences between an 88(1) tax-free transfer, 88(2) is not a tax-free transfer provision. So that brings us to the end of this tutorial on Section 87 and Section 88(1). Good luck with your studies.